Jesse.
What's up, man?
Okay, you can hear me. Oh, perfect. Oh, wow, your video looks better than mine. That's awesome. Okay. You know what? Should have done a dry run before the live, but
It's all good, man. It just means that you were probably helping somebody out before we hopped on here, which is all good.
I was in the middle of like replying to something and whatever it was, and I was like, oh, it is 11:59.
Yeah, good.
Yeah, but so thanks for joining me. As I mentioned before, I just wanted to talk to you about some credit stuff, really for consumers, and I guess some realtors as well, and some loan
Yeah.
officers. They don't know some of the basics, and we get a lot of information from friends, family, online. Dave Ramsey, who knows, I guess the facts are, there are credit laws, and there are ways that credit is handled, and we're just kind of like just sharing the information, consolidating what we know, and kind of translating it to people so they know, what to look for, and they're not searching for information all over the place, right? Because there's laws, consumer financial protection laws. Each credit bureau's got their own thing, but from our perspective, credit is important for lending. So we look at it every day, and it's great that we have partners like you guys, you and Sam and the team, to help people that need additional help. That we're not experts on credit. We know some stuff because we see it a lot, but we don't get into the weeds with it.
Yeah, it's a really, when it all comes down to it, if you want to know a little bit about credit, it can go down a very deep rabbit hole. And there, like when you start to overlay like a person's specific scenario of what they're dealing with and what they're hoping to use good credit for, there's a lot of different variables that need to be discussed in order to give good sound advice on what happens next.
Mm-hmm.
And when you think about My Credit Guy and all that we're responsible for, really our knowledge and what we do is really directing people to make good decisions based on their specific situation and what it is that they want to accomplish. So, today we're living in a time where, if even it's me too, right? Like if I think of a question, one of the first things I do is Google it, right?
Yeah.
I want to get some additional insight. And the problem that we're facing is that right now, as it relates to credit specific education, there's so much bad information that's out there, right? And it's the problem is that it's easy. Everybody thinks in going into credit, there's got to be some loophole or some trick of something that we can do. So the messaging that's being delivered through content today is loaded with that information, and people are drawn to it because it's interesting. And the problem is that we're oftentimes we're landing on somebody that their most important objective is to get more likes, comments, and shares because their presence on social media is valuable to them.
Mm-hmm.
Where, with My Credit Guy, our position is this is an example of it, right? Michael, like we're partners with loan officers to help people truly better understand their credit. And if it's before they've established credit, it's to work to create good credit, right? Like what are the behaviors? What are the things that you can do? And then if it's people that have had mishaps in the past, it's to fix it, right? It's usually one of those two scenarios in order to be able to leverage that credit to get into a home, which is obviously a really fantastic financial decision from an investment point.
No, exactly. And I kind of compare credit to a person's health, something you got to kind of take care of from the beginning. And, when someone goes to the emergency room, it's, they, not for an accident, but, it's a long, they've had health issues for a while. They didn't take care of themselves, and then it gets to the point where it's really bad. That's when they decide to make changes. And the same thing with credit. They usually don't come to you guys until they've already had a history of, either making wrong decisions or maybe life events that cause the credit to get, to be damaged, and then they need to fix it.
Yeah.
And unfortunately, a lot of people don't do that, sooner. Like they will reach out to a realtor to start the process, and the realtor will refer them to a mortgage broker or other way around, and then they want to buy a home. And then at that point, it's like, well, you're not ready yet. You have the need, you have the income, but you haven't really been taking care of your health, your credit health for a while.
That's one
So
of the things that was really interesting for me when it came time to buy my first house. I was like, okay, like I want to buy a house, so I'm gonna go to the house salespeople, which are
yeah,
real estate agents, right? Like,
yeah,
and if I would have been led appropriately, I'd probably say, well, credit's really important. Let's get a good baseline understanding of where you're at from there. And let's take that understanding of credit and let's get it in front of somebody that can produce a mortgage for me to find out what my options are for financing. And then hopefully they have somebody that's really important in their network or valuable in their network that can show me the houses that I'm qualified for. But the world that we live in is that process is really backwards, like you've explained.
yeah. So let's get into some of the details. Like what, from your perspective, from I guess the clients you guys speak to, what do you hear are the most common misconceptions about credit? And you could be as general as you'd like or as specific as you like.
Yeah, that's a long list, right? So, for us, it's some specific things like, well, with collections, all you got to do is pay them off, right? Like once something's paid off, it's fixed. And not only is that a big misconception, but it also is a detriment to the potential for improvement because, most of the time we're dealing with collections. We want that money that's owed to be leveraged for the deal that we're going to work, the negotiation. So it handcuffs us a little bit. I'd say that really, and the reason I bring that what I would consider one of the number one misconceptions up is because it aligns with people making decisions based on good judgment or a rational decision, right? Like, doesn't it make sense that if you paid something and you did your part, you fixed the problem that you had, that you should be, released from that? I mean, that's rational. Unfortunately, the credit scoring algorithm doesn't work that way. So I like to talk about that just because so many people,
Yeah.
mention it.
Um, yeah. So for people watching who don't know, a collection is when you owe money to a company. That company stops collecting from you, so they sell that debt to another company, usually at a steep discount. So it's off their hands, off their books, and so the collection companies, their sole purpose is to collect money. And even though you may have owed Bank of America $1,000 and defaulted, they sold that for like $100.
Yeah.
But the collection company, they're still going to try and collect the full $1,000 because that's really what you still owe plus penalties and fees. So, like Jesse said, when you pay it off, it's done. It's paid off, and you can't do anything else about it because you paid off a loan, and that's all they're going to do. Like, there's no way to fix it. So, what would you recommend for like a collection account then? Like, what would be the ideal situation to get the most out of the credit rehab?
Yeah. So for us, it goes one layer deep, and that is if it's just one collection, then we're going to want to take that and negotiate, after we've disputed just to confirm that it is valid, it's accurate. They have what they need to prove that it's your responsibility. Our team would go negotiate most likely a pay for deletion, right? So we're going to use some of your money to leverage getting the agreement that we want, which is for that to get removed. And so let's use that $1,000 scenario. We might be able to negotiate that for $400 to $500, which seems kind of wild, but at the end of the day, like if we were to go back to what they invested, like Michael said, it was they paid $100 essentially for the paper to that organization that bought it. That's a win for them because they're really just working on the gap, the profit, right? They want to make money off the work that they do. So that's where our team does the best, is that there's pretty not a lot of credit reports that we see with the collection or a charge off on it that we haven't done business with the collector in that situation. We know a lot of times we know people within the organization where we can work through that process. So, I mean, this would be an example of like, you can do this yourself, but why? For the small amount of money that people pay us, it usually just goes a lot smoother. And that's why we have an organization. Now, I'll say a couple additional pieces on the collection. One would be like, if you have multiple collections, one of the most valuable pieces of us getting involved is that we're going to prioritize that, because another misconception would be the collection that has the larger amount owed is going to affect my credit more. And that's not necessarily the case. There's so many different factors of data that are taken into consideration just with a collection. Like, when was it open? What's the date of last activity on it? Those are all, dynamic factors that go into the credit scoring algorithm. The other thing
Um,
that I'll say is just that, in July, medical data shifted, right? So if we can pay that down to zero, those come off, and another update next. So like this is an example. It's constantly evolving as to what are the rules, what's allowed, what's in your best interest. So it is very complex.
how would you guys work on a charge off compared to a collection? And a charge off is when you don't pay the debt, but they don't sell it, so the lender just kind of, I guess, writes it off as a loss,
Yeah,
right?
charge-off would be an example of somebody that's still holding that debt, right? It's still an account that's active in their system. They're showing it on their books. They're probably, writing it off as a loss, and it just hasn't been transitioned to an outside vendor to collect on it yet.
Right.
What I'm seeing a little bit more of lately is that in those situations, not only are they selling them off, but they're leasing that debt. So it's going to show up that it's still active and they're aware of the situation. In those scenarios, it really just depends on what type of charge off it is. When I see charge offs, most of the time they're credit cards, but charge offs can also be considered a repossession, right? Sometimes they're coded as a repossession is coded as a charge off on an auto vehicle as well. But we're usually seeing much larger amounts there. So one of the things that we do that oftentimes creates a benefit and a lift in and credit score is that we're going to settle that for less than the full balance, right? So and a lot, time has a big factor there. If it's been open for 6 or so years, we might be able to negotiate a little, more aggressive position. And then, our disputing team, when we're going to clean things up on the back end, when we're dealing with an account that has a $0 balance, the creditors find that much less important than one that has a $7,000 balance, right? Like,
Right.
what we have to remember is they're just managing data, their accounts on that end.
Yeah, I mean, why would they do anything if what are they going to gain?
You would be surprised. That's one of the hardest questions to answer. If I don't owe them any money, why do they even care, right?
Yeah,
It's
exactly.
Yep.
So what happens if someone does not take care of their collections or charge offs? Like, there's some statute of limitations where they're not collectible at some point. Can they be bought and sold and restart that clock so they kind of?
This is a really great question because it feeds into what another piece of like common misconceptions is. Everybody thinks that if they hit that federal 7-year mark, that everything's just going to disappear. And really, the details, without it getting into a bunch of the legal stuff, really the details just say that if it's gone to the point of 7 years, again, that's the federal statute, that entity can no longer pursue you for that debt. It doesn't mean that it automatically comes off the credit report. It doesn't mean that you're automatically getting an increase in score. It just means that Citibank's no longer going to come after you for that money. But again, if it's a significant amount of money, they're going to exhaust all efforts to recoup that loss as best as they can. So expect, especially on a charge off, because it's still with that original creditor, for them to come after you somehow from a legal standpoint, which, what we see most often is like a civil judgment or a garnishment of wages. And that's super inconvenient. So, the thing that we continue to echo is that, the best time to at least acknowledge what's happening on your credit and fix it is now, right? Like,
Oh, Jesse.
did you lose me on video there?
Oh yeah. Okay, you're back.
Yeah, the call come in. Sorry about that.
Yeah, no worries. Yeah. The sooner the better. I do find that some people don't know about their collections, like medical. That's usually the biggest surprise. Like, people don't know that their doctor will just put them to collections after like 30 days or whatever it is. Those are the most common I see. And also like utilities, or returning, like they forgot to turn in like a $60 cable box when they moved from Comcast, and now they have a collection that's like $300,
Yep.
So people don't realize that those things even exist in their credit, because most people aren't checking their credit regularly unless they have a purpose for it.
Yeah, and then to expand on that, if identity theft is through the roof right now, and if somebody happens to open an account in your name, or if there's a data discrepancy, you could have a collection on your report that's not yours. I see it all the time.
Right.
And, unless you're monitoring your credit consistently, you're going to find out about that at the worst time when you're trying to buy something.
Yeah.
So it's important to be connected with a professional like Michael. If you have issues you need to resolve with credit, our team gives a free consultation to like review specifically what's happening on your, just knowing what's happening is important.
Yeah. So you'd say it's important that people review their credit and look for inaccuracies, like even minor ones, like wrong address, or maybe a name misspelling, something that may indicate that something maybe someone accessed their account, or maybe the credit bureau's maybe merged data with someone else, right?
Yeah, anytime that there's something on your credit report that is not you and is not accurate, it's important because it could lead towards something more that'll be a detriment. Absolutely.
Okay. So let's talk about in general credit repair, right? Because I know you guys are great, and you've probably given more free advice to my clients than you have actually worked with some clients.
Yeah.
And there are all kinds of other companies and individuals that do or advertise credit repair. There are other companies, there are individuals, law firms, and even this is kind of I don't like it, but there's like kind of MLMs where people do like affiliates, right? Or all of a sudden
Yeah.
your neighbor says, "Oh, I do credit repair now," right? And who knows what's actually being done with your credit? But what are the main differences in like the options of credit repair? What can or can't actually be done, and when would an attorney actually be needed? At what point?
Yeah, great question. So, what separates my credit guy from any other credit repair company out there is our people, right? So there's large organizations that tout that they're a credit improvement type company. They might deal with 3 to 4 more files on a monthly basis than we do, but they have half the staff, right? So like what type of service are you getting in those situations? At my credit guy, we're human driven, right? Like where there's people behind the scenes that are looking over what's happening, looking over the results of disputes. They're on the phone with the client to help coach them and understand them, help them understand what's happening on their credit, and then make the decision of what happens next. So this confusion that takes place with even understanding your credit, that's going to continue as it relates to improvement, right? So you need somebody along your side to say, here's what this is, and here's what we do next, right? So that really is the difference between us and others that are out there. And it's just knowledge, right? So the MLM thing that you bring up, that somebody splashed into the marketplace and said, "Oh, there's huge money to be made in credit repair," and there is for the people that decide they want to be deceitful and just turn on a switch, right? And that's where credit repair gets a really bad name. And the problem is that you have a bunch of people selling something for improvement, and a bunch of people that are in a tough spot they are saying like, "I need help," right? So they're often, those, when you're in that situation, it's easy to get taken advantage of, and people are making a decision that that's okay with them. That's where we're different. We'll turn somebody away to say, the money that you're going to spend with us right now is not going to get you to that goal of home ownership as quickly as you'd like. I would suggest saving some money and then come into our program, right? Like, where we're different is that our goal and where we're aligned with the loan officer as professionals is that our goal is home ownership, right? Like we don't just want to fix your credit. We want to fix your credit so we can get you back to Michael. Michael can repull credit and put in front of you the options that he has to get you into a home or refinance the property that you have. Mm-hmm. That's the difference. We're focused on a mortgage.
Yeah. I mean, what I see a lot are people that get into these programs for credit repair where they're just paying monthly fees. And they don't know really what's happening behind the scenes. They don't know the results.
Yeah.
And a lot of these companies, all they're doing is just contesting debt. That's their whole program is just writing these like boilerplate letters asking these companies to confirm the debt. And I don't know. I mean, I don't think it's effective. If it's a valid debt, it's a valid debt. And all they're doing is taking money from people on a monthly basis to keep them in a program with really no end goal. No end goal in sight.
The structure of our organization was built by Sam and Trisha Parker, and Sam often talks about like what's next, right? If you're working towards a goal, what's next? And if you're working with a different company that just continues to dispute a valid debt, you're not really addressing the question of what's next to get to your goal of home ownership. That's why, in our situation, you'd pick up the phone and say, "Looks like it was validated," right? And our credit coach would probably already be working to call you to discuss the update. We're going to say, "Here's what's next," right? Yeah. To truly drive it towards, progressing up and getting you into that home.
Yeah. I mean, I'll see on people's credit reports, you can see they contested it. It's all there. And it says dispute resolved, debt validated, consumer disagreed. That's the worst that they can do.
Yeah.
And there are definitely, I mean, we've all seen it. There are credit repair companies, even law firms that will say we can remove bankruptcies and judgments and foreclosures from your credit. What are your thoughts on that? I mean, those are definitely valid and serious things. You
Yeah,
know,
here's the thing. Every time I've gone down that path of like working to understand like who does that and how, it's always that it if they're super successful at it, it could come off, but it's going to show right back up, right? Like, and it just creates more of a challenge down the road because if I removed like a BK, a bankruptcy from your credit report so that it's no longer there, your credit score goes up, you're going to go through underwriting with Michael, that's going to get flagged. The credit report is not the only thing that's being used to say, let's vet this person to ensure that they're
right?
credible, right, to lend to. And now you've just gone down this process and you have to back out of it and redo things. And that's a waste of time and most likely a good amount of money.
Yeah, for sure. I mean, a bankruptcy is a bankruptcy. It's a legal process. A judgment, foreclosures, those are all legal process. So there's court
Well,
records.
and the
You know,
thing, you can come back from all of that, right?
yeah.
But
Oh, sure.
you can't sidestep it and not deal with it the way that you should. Like for anybody that's been through any of those things that's listening, it doesn't mean dead end. It just means you have to really know who you're talking to that's consulting you through that process. And for anybody that's got the quick fix, I mean, it really goes back to that old saying of like, if it sounds too good to be true, it
Yeah.
probably is, right? Like it's just how it is.
Right. So like a judgment, that's kind of like a collection that went too far, but something like a bankruptcy or foreclosure, those are like, like moments in time where it's like, okay, now like that's already done. How do
Yeah.
we move forward from here? You
Yeah.
know,
Absolutely.
and the people that say or that think they need to get a bankruptcy removed or foreclosure removed, most of those people I found is they just didn't take that event and say, okay, now I'm going to make changes, to prevent
Yeah.
this from happening again or rebuild my credit. Because I've seen people rebound from a bankruptcy like less than 2 years later and have over 700 FICO scores.
Yeah.
Because they did the right things. They took it wasn't really even expensive. You could open up like small, like prepaid credit cards to reestablish credit and just
Yep.
kind of keep doing the right thing. And before you know it, your scores would be great.
Yep.
Yeah.
Absolutely.
And okay, a couple more questions though. But another thing that comes up a lot is are people that have a lot of debt and they get talking to these debt management programs. There's all different kinds. I don't know the details of all of them, but from my experience, what I've seen is these companies will take monthly payments from people, tell them to default on their debts,
Yeah.
right? And then it's like a long-term thing where they just these companies get pay themselves first, and then whatever's left over, they start to negotiate debt after that, right?
Yeah.
Um,
It creates a huge mess. It's debt relief, right? So I kind of categorize all of those in the debt relief category. And I mean, unfortunately, we're just in this space to where when people have financial strain, they are easily taken advantage of because people are selling hope, right? And in those situations, you're gonna solve one problem potentially. You're gonna end up paying less than what you originally owed.
mhm.
Okay, so like there's a good, better, best scale and everything you can do, and that really is never debt relief has never really been the best full answer when I'm looking at somebody's debt, right? Because we just talked about it in bankruptcy, right? So like we allow for the loan officer to give direction, with anything financially, but for us, our focus is fixing things and resolving debt so that you can build off of that. And unfortunately, if you go through a debt relief program, once you're finished, which it could be 3, 4, 5 years
Yeah.
to get to the point, because what you're doing is, let's say you save 60% on your debt. Well, that 40% that you save, like 10 to 15 or 20% of that's actually going to the company that's doing the debt relief for you. So in the end, you save 25 to 30% maybe, while trashing everything that you have on your credit report, relationships with banks, and really losing the potential for reestablishing good credit with those specifically, and then a really long-term process to fix everything else. So it puts you out of the running for anything good for quite some time. And it's just, what you get from a value standpoint is greatly outweighed with the cost that you pay. So in those scenarios, a lot of times when I'm looking at debt that is insurmountable, I don't say go through a bankruptcy. I say consult with an attorney, right?
Yeah.
Like work, and that's like, let's just, if it was just us, I'd say go back to Michael, talk through. I mean, if your goal is home ownership, he probably has a referral to somebody that's a bankruptcy attorney that he trusts, and you can at least talk through this process. And we'll still be here if you decide not to do that. We'll still be here to say, well, we have a different way to tackle it. It might take a little longer, and it might take some money, right? Like a lot of times the decision that's best is really has a lot to do with like how much cash do you have and how much can you put towards this improvement process. So there's no one quick answer, but it's almost never debt relief, if I'm being honest.
Yeah. How much cash do you have to fix this now, or what's your monthly budget
Correct.
For an ongoing thing? But if someone is, maybe a candidate for bankruptcy, then they're not going to most likely qualify for a mortgage right now.
Correct.
But again, same with you. Like, we don't advise bankruptcy because we're not lawyers.
Yeah.
But we would say, look, you have a lot going on. You may want to consult with a bankruptcy attorney, and here's a good one that we've worked with before that will give you solid advice.
There you go.
Yeah. Even some bankruptcy attorneys, like, they're humans. Some of them are better than others. Some will give good advice, some won't. There's different kinds of bankruptcies. Who knows which is the best option? But I've helped people buy houses while they're in active Chapter 13 bankruptcies.
Yep.
And if they just let debts fester and go on, like, that would just delay their home ownership journey like years and years, if at all. I have a client right now. His bankruptcy was finished. He's just waiting for the discharge, the Chapter 13. But we got court approval yesterday to buy a house, and his bankruptcy just ended. So he hasn't even gotten the paperwork yet.
Yeah.
But if you just let things fester and fester, you're just kind of dragging things out and probably costing you a lot more money anyways.
It really is. Yeah.
So a lot of good info there. Let's talk about the credit bureaus. Now, they're just so everyone knows, the credit bureaus are they're for-profit companies. I guess they're kind of marketing companies. They market services as well, and they sell your information. But they also all have different scoring models, so your scores are different. It's different when I run it, when you apply for a credit card or a car loan, but also different when you look at it on your own through like Credit Karma, or a lot of credit card companies will offer like, hey, we'll check your credit for you. There's a lot of credit scoring models, but can you briefly just go over the differences between them and really just between the mortgage and the consumer side?
Yeah. The easiest way to combine a lot of information and have it be consumable as it relates to those that provide the data that builds a credit score, which would be, Experian, TransUnion, and Equifax are the data collectors. They're the credit bureaus, right? Like, they have all the information, and then they run that information through a program or a scoring algorithm that's a product essentially through FICO or Vantage, right? So, and then from those models is produced a score, okay? And that's just really, it's a risk assessment. It's a grading scale, right, of where you're at financially, as it pertains to that data that they've collected. So when you think through that, FICO specifically has a lot of scoring models. They've got one for one or two for if you're going to get an auto loan. They've got several for if you're going to get a credit card. For a mortgage, FICO is built right now, version 5, 4, and 2. And what that is that each one of those bureaus is producing, one of those scoring models, right? So one bureau has 5, one bureau has 4, one bureau has 2. So you've got 3 separate scores on your mortgage report that Michael would pull. Now, when we go into the Vantage category, up until recently, they've just been a consumer type of scoring a model and program. It's an organization that's actually owned by Experian, TransUnion, and Equifax, interestingly enough. And for the longest time, when we would say Vantage 3.0, that was our answer to like, where's this information coming from when you're on Credit Sesame or Credit Karma or whatever the case may be. And it is a consumer model, right? Which is going to vary greatly on the report that Michael pulls for a mortgage. Now, what's recently been announced is that Vantage 4.0, which is the new version of 3.0, there's going to be a slight variance. They're going to, start tracking trending data, but within the next couple of years, it's not something that'll roll out super fast. Partnered with the FICO 10T, which is the newest model that they have, and T stands for trending, are going to be the models, the two separate models from two separate entities that are going to produce scores for a mortgage. So if you're a consumer, the only thing really that's important to know is that the credit score that's associated with what I'm trying to finance is what's most important, right? And working to understand from your lender what that is going to be helpful as you work towards the best score that you can get. But
Right.
through all of those scoring models, really the fundamentals are the same. Okay? Pay your bills on time. Make sure that you have credit cards open because credit utilization is important.
Yep.
Maintain lower balances on that, right? If somebody's going to loan you $1,000 that's revolving every single month that you'll be able to use, you don't need to use all 1,000 of it because that's not going to look good. It means that you're kind of overstretched on that. You're using too much, right? So we work on the good, better, best process. Less than 50% utilization on a $1,000 card. That's less than $500. Less than 30% is better. So good is 50, better is 30, best is 10%, right? And on a $1,000 trade line, that's less than $100 that reports every month for you.
Right.
So all of those factors go into the scoring models, like the FICO 10T, like the Vantage 4.0, which will produce a score. But I just circle back around on all of this, right? Like I'm assuming as a consumer, as you're listening to you're like, this is a lot of information. And that's why it's so important just to have a trusted partner that's truly an advisor, right? To help navigate that detail for you and break down those specifics. They're the director of what it is that you're trying to accomplish. And having a human that's a person that sounds and proves that they know what they're talking about is going to make a monster difference in any large investment you're going to make, specifically a home.
What would you say is a great way for someone to monitor their credit? Because Credit Karma, they market a lot of other services, right? I mean,
Yeah.
credit bureaus sell your information as well, but Credit Karma, Credit Sesame, whatever, all those services, they have great apps. They're very convenient. They give scores that are very, flattering,
Yeah.
But like you said, and this is what I've been telling people for years, like, I don't want to hear what your consumer score is. It doesn't really matter,
Yeah.
and if you're, because ours is A, gonna be different, but B, you should be more focused on your profile. Like you said, make sure.
Yeah, the complete profile. Yeah. So, I mean, like even I'm gonna get slapped for this, but even Credit Karma to some extent is valuable, right? It's showing you the detail of those trade lines.
Sure.
You just have to understand what you're accessing, right? Like Credit Karma is just one bureau, right? You're not going to see the other two bureaus and the detail that might be there that's not on that one particular credit bureau, right? So like you only get 33% of the information. You need 100. What I like personally is all three credit bureaus, right? There's plenty of companies that are out there. We use Identity IQ a lot to monitor credit. It's a low cost. You're going to spend some money, but for like $20 a month, you have access every single month to a new report and you get the information that's valuable. Now, the scoring model is based on Vantage 3.0, right? So you're going to have to take that in consideration. That the scores are different, but the details and the trending specifics on your accounts are all there. If you're super, super particular and specific, I would say use My FICO, right? If you want to access if you're going for a home and you want to access your mortgage scores, it's available on myfico.com, which is a great app. I use it a lot. Most people just don't because it's like $45 a month, right? So, but think about a $45 investment every single month to make sure that you capitalize on the best interest rates you can get for what will probably be the largest purchase that you ever make. It's a drop in the bucket. It's nothing, right? Because, Michael would tell you the difference between a 580, 620, 660, 680, 720, 740, 760. It's a lot of money, right? And what you'll pay over the course of a loan. So for you to be invested on understanding credit and to partner with a loan officer, right? So like if I was a consumer, I'd be asking these questions to Michael. Michael, here's the deal. My Credit Karma says I have a 620. I know that that's not important to you. I've understood some details that is happening on my credit. I'm switching over to my FICO. I'm actually going to see what you see. Tell me, what's the thresholds of importance here? If I get to a 620, could you get me approved? 640, right? Like that's good. if I get above a 680, can I get a better rate, or can I have some other options that are available to me as far as loans go? And he's going to give you that direction. Like, he'll be able to answer those questions to say, I'm going to help you establish credit goals that are score driven, right? Those make a huge impact on when it comes time to sign on the dotted line for this transaction, for this investment. There's a big deal.
Right. Some lenders won't give people credit advice, I mean, consumers shop around, right? It's expected, right? It's normal. But sometimes you'll have a new client and you'll run their credit and they'll have a quote from someone else, and you'll see like, hey, like, you're 2 points away from the next tier of credit. Did they tell you what you should do to maybe get 2 more points just to save you, maybe $20 a month, or maybe it's more, maybe it's like $5,000, and maybe you're from like a 638 to a 640, and that's a big difference for some loan programs.
Yeah.
Do you have any tips for like any like tricks for just like a couple points to increase the score, like something very small, like something that can be done other than paying down the balance? Like, is there any credit tricks that can do quick improvements?
Yeah, so we have seen that going to optoutprescreen.com and pulling yourself from those just standard automated like offers that are out there, that we're seeing an increase in anywhere from 4 to 7 points. We think we can tie it to that. So just a quick little bump, always opt out pre. I like opt out pre-screen, not only because it's gonna bump my credit just to single digits, just a little bit, but I'm not getting those pre-approved offers in my mail anymore. Right? Like, I'm not. If there could be an opt out pre-screen for the political stuff that shows up in my mailbox, that'd be even better. But it's really like an example of that would be a furniture store that's in your area. What they do is they go pull data to say, in this zip code, how many people are within this age range or whatever demographic that they want to put, and then they'll run it against a simulator that does a soft pull in your credit, essentially to say this person's within a whatever credit score, right? It's not a hard pull, but like your credit is being pulled every single day without you knowing it. It's just not being pulled as a hard inquiry for you for a lending purpose. It's to advertise to you. Right. So if you take yourself off that list, they're not going to run you through that simulator. You're not going to get that, offer from the furniture store that said you can buy, a couch for no interest for 24 months.
It brings up a couple of things actually. There's a fourth credit bureau, right? Enovis. And their sole purpose is to generate these mailing lists, right, for the pre-approved offers. I believe that's all they do. I think. I mean, if you know more than I do, let me know. But it's just
they're a collector, right? They're a data collector.
They're a data collector, and they compile data and they make mailing lists, just for these purposes. But opt-out pre-screen, which I tell everybody, all new clients, like, hey, like, I'm not going to run your credit today. I want you to sign up for this website to prevent what's called trigger leads, right? Because when you run your credit, they also sell your information, the credit bureaus, and they'll say, hey, this person had their credit ran for a mortgage. And that's just, it's
wild.
Yeah, it's wild. And then so you'll get your phone blown up. You'll get text messages. Like,
literally blown up. Yeah.
You'll be on the list forever. So I tell people, like, hey, sign up, wait at least 5 business days. So let's say a week before you run your credit, but we'll review your file. We'll do a soft pull, like you said, which doesn't show up to at least get an idea what's going on, and if we have to run a full report now because there's some issues or you're in a time crunch, sure. But, unless there's a rush, like, I'd rather wait and make sure you're protected. So I advise opt-out pre-screen. I advise people to sign up for the do not call list, donotcall.gov. And unrelated to credit, but there's another website, dmachoice.org, that'll prevent people from getting, and it's not credit related, but you won't get like flyers and catalogs and stuff in the mail, right? So just keep it clean, maintain some privacy and, protect the environment, I guess,
Save some trees for sure. Yeah.
So a question about the soft pull. So I know the purpose of that, right? From these companies, so they can, pre-approve you before they send you offers.
Yeah.
But are those the same scoring models? Is it just because when we pull it, we pull a soft pull, so it doesn't trigger, so it doesn't count against them because they may not be ready to buy now. It may be kind of just investigative work because they're maybe months away just to get an idea what's going on, to maybe give advice.
It's going to be based on what it is, right? So like, and this is being sold to them, right? So if you're a credit card company that's like, we've got space to lend another, $50 million. We want to go find some people that are, subprime credit because we're gonna charge them a higher interest rate, right? What they'll do is they'll say, again, here's the demographics, and what they'll use for their scores is the model that's probably specific to the product that they're
Right.
offering, right? So if it's a credit card, it'll be one of FICO's credit card models. Yeah, if it's a mortgage, it could absolutely be a mortgage. You might have mortgage companies that are out there that are targeting lower credit score leads because, if they're great companies, maybe they're partnering with us to say we want to make sure that they understand the education that's available so they can improve credit. If they're, everything can be marketed and spun so many different ways, positive and negative. And I would say that there probably are companies out there that are buying trigger leads that are using those with integrity. But what we're getting exposed to right now is a lot of those that aren't, right? Like just so many calls. So to answer your question, the scores that they're producing and the criteria that they're creating are probably more specific to the model of the product that they're selling.
Did you just mention that you said some credit card companies will partner with like credit repair and send out kind of materials for that?
No, we have mortgage companies that don't shy away from challenging credit because they know they have strength in our partnership, right? Okay. And they truly want to help educate that people group to say, like, listen, just because, and even bankruptcies, right? Just because you've had a bankruptcy in the past, just because you have some blemishes on the credit doesn't mean that you can't buy a house, right? So there's people that might look at credit report and say this person's got bad credit, see you later, I don't want to deal with this headache. But there's also people that run towards that because they know I have a solution for it. That's
right. Well, from what I do and a lot of people I work with are the same. Like, we don't run away from borrowers with challenging credit or say no. It's more of like, okay, well, not now, right?
Yeah.
But here's what you have to do: steps A, B, and C. If you want to buy a house, you're going to have to work, right? You want to lose weight, you're going to have to work, right? But you have a goal, and your goal is to stop renting. Your goal is to lose 50 pounds. Like, these are the steps you got to take, and then it's up to you. We'll be here. We'll stay in touch, check in on you, but we're not going to be able to hold your hand every step of the way and check every month that you're paying your bills. But at least you know that you've gotten good advice and you know what you need to do to get to where you want to go.
There's really no such thing as a DIY or do it for me, DIFY, right? Do it for me, self-improvement in any category, financially, fitness. Like, you have to do the personal investment and time, energy, effort, the emotional investment. Like, you have to be committed to those things. And if you're expecting the result that you want, right? You got to work towards what is good.
Right. Yeah. I mean, there's one thing to have, credit issues and fix them, but you also have to kind of address like how you got there in the first place.
For sure.
Whether it's budgeting, I forgot who this was. Someone, oh my goodness, Nathan Einkorn. I'm going to shout out to Nathan Einkorn. He had a client who had like a $17 a day Starbucks habit, and just put him in the right path to change some habits. And then sure enough, homeowner,
Yeah.
like they changed what was holding them back.
It's funny how often that person that knows that they're spending $17 a day doesn't know, right, that they're spending $450+ a month on coffee, right? Like, it's that connection sometime to say, here's what it's truly costing you, right? Like, maybe half a mortgage payment. It's crazy.
Yeah, and that's a lot. And you can't save up money if you're throwing it away and you're drinking it,
Yeah.
you're drinking your down payment is what you're doing. Yeah. Oh man. All right. I mean, that's all I pretty much got. Oh, one more question. We kind of briefly touched with the new scoring models, right? Yeah. You said they're using trending data. Can you explain trending data?
So go ahead.
Yeah. No, explain trending data. And I'm wondering, will these new scoring models, will they help most people, or will they actually hurt other people's credit scores?
So to make a blanket, statement on help or hurt, it, especially with data and how it's aggregated, is like, it's impossible. But what I can tell you is that there are some specifics. One, trending data is super important now. And here's an example. I mentioned earlier that your credit utilization.
Yep.
Right? We use that $1,000 credit card. If I had a $450 balance on that $1,000 card, I'm 45% utilized. Right? Now, if you pull credit, Michael, and I'm 45% utilized today, and Jesse says if you get below 30, you're gonna see an increase in score. You can make that change right now, and you're immediately gonna, see the results of that increased score. Well, what the trending data is saying is that now, instead of just that snapshot of what today is, they're going to be able to analyze the last 24 to 30 months of that ebbs and flows of that utilization. So now more than ever, it's going to be important to maintain balances that are below those thresholds the entire time. So it's more of an every day, every month behavior than it is, I got to hurry up. It's going to be tough for me because I'm one of those people that's like, I got a test tomorrow, I'm going to study tonight. Right.
Yeah.
And we can't do that anymore. We're going to have to model good behaviors as it relates to on-time payments, maintaining balances every single month going forward. And it's really good to start thinking around those things right now, because we're not expecting for the scoring algorithms to hit for, they said multi-year, right? And all I'm going to say is, like, I'm just saying probably about 2 years to where these new scoring algorithms will play out to be something that will be used to lend to you. So let's start those good behaviors now. The other thing specifically that's taking place, which I think is a huge benefit, this is great for a lot of people, is that up until now, the only time that you saw your utility company, your landlord for your rent, or your cell phone company hit your credit report is if you failed, right?
Yeah.
And it went to charge off collection, whatever the case may be. Now they're going to be, I don't know, either required, or you're going to be able to work through a self-reporting process. That's still up in the air to account for those. Your rent, your utilities, your cell phone bill are all going to be positive effects to the credit score that is being used for a mortgage. Now, a lot of people will say, well, I have Experian Boost. I've already been sending over my cell phone and listen, first and foremost, it's only reporting to Experian. And second of all, it's not in the scoring algorithm that creates a positive, trend up or adds to your credit score for a mortgage. It's just showing up on that consumer report.
Right. I mean, it's important to show those things that they get factored in, because you pay rent for a long time. Why wouldn't that help your credit score? It's like, hey, I'm paying a valid, obligation. Same with my utilities, my cell phone, my insurance. I mean, that's why some loan products will, if the borrower's got some iffy credit situation, they'll look at alternative lines of credit. Like, why couldn't that be included in the first place?
Yeah.
Things like that. But with the trending data, though, okay, so let's say you have two people. One person carries a high balance forever. They apply for a mortgage, and then the mortgage guy says, pay it down to 10%, and we'll do a rescore and repull it, right? So the trending data shows high utilization. Person two had low utilization, but let's say, had an expense last minute. Their balance went up, almost maxed it out. Same thing. Mortgage guy says, pay it down, or rescore and update it, right? So how would that be factored into the scores? Because they're both.
Number two is in a better situation because they're holding, a positive mark for, 23 of the 24 months, while the scenario number two is getting like a C level grade or a D throughout that entire time.
Yeah, it'd be interesting to see how that actually plays out.
At least that's the idea, right? I mean, like that's the thing about the information that we have right now, is we can only speculate based on the detail that we have. But it wouldn't make sense if it went any other way.
I wonder if the person that usually carries a high debt and it just pays off quickly just to qualify, right? I wonder how much of an improvement that may actually get them with the trending data.
It'll still have an impact, I would imagine. I just don't know in the future how it'll be. And this specific conversation, it's really important for like business owners, big or small, that have like that one or two cards where they operate a lot of their expenses. There's a lot of people I know that they're like, I pay my credit card off every single month, but I run it through here because I get the points or I get the rewards. And it's like, okay, well, that's perfectly fine to continue to do. What's going to be important for you now is to understand, when does that credit card report to the credit bureaus? Because you're not going to want to send that balance up to them, right? Yeah. Like if you're paying it off every month, pay that thing off so that it goes to less than 10% of a balance before that bureau reporting date, right? Like get that thing adjusted down before they kick that information off to the credit bureaus.
Yeah, and you can call the credit card companies and ask them when they report, right?
Correct.
I mean, I don't think they're all on them, beginning, end of the month. Sometimes they're middle of the month. I guess maybe depends on when you open the account. I guess I don't know. I'm not really sure.
You can have two separate accounts with the same creditor, and they're two different credit cards, and they can report on a different date. I have two of them that are that way.
Well, I know some cards will do like a net 30,
Yeah.
where it doesn't report the same, I don't think, as a revolving debt because you're supposed to pay it off every month.
Right. And I mean, that's just another thing of like, just call and ask the question, right? Just call and ask the question, when does this report to the credit bureaus?
Yeah. Oh man, this is good stuff. Well, thank you, Jesse. Any other last minute tips, tricks, things to look out for?
We covered it all, really. I mean, I'll just express again, the best time to like look and understand where you're at from a credit standpoint is right now, because if there's something that needs to be fixed, that takes time, right? So prepare yourself to take advantage of everything that you can with having the best credit you possibly can have.
Yeah. And just to reiterate, people should sign up for the opt-out pre-screen unless you like getting junk and spam calls. And also didn't mention this, but almost all the monitoring services cost money. The ones that are cheap, like Credit Karma, I believe, is not that expensive. It's because they're marketing so they're making money other ways. But it's if you can get a free credit report, anybody, annualcreditreport.com. By law, you're allowed to get it once a year. So it's actually, I think it's legally required. So 3 credit bureaus sponsor it. So you get your 3 credit reports, no scores. And I think because of COVID, they've increased that more than annually. I don't know if it's unlimited now or maybe.
Yeah, I don't know if it's still open, but they were doing a refresh on a fresh credit report every month. And I think the height of the pandemic, you're doing it more. People could do it more often. I think maybe I'm wrong. Maybe it was always that monthly. They could get a new report every single month. I'm not sure if that's still going though. But it was definitely active during the pandemic though.
Yeah, and that's a great idea to check your credit. The other services are great because you get notifications. Inquiries. You'll get a text message. You'll get on your phone like, hey, your credit was ran by XYZ. And I would have clients rightfully call me and say, hey, you checked my credit. Is this you? Just to confirm. And that's what you should do.
Yeah.
Monitor it. Any changes, reach out and just make sure you know what you're doing. Sure. And there's nothing wrong with freezing your credit report so you don't get things put on there without your knowledge.
Right.
Kind of a pain to unlock it, but not, it's a small price to pay for protection because fixing things could be expensive and time consuming. All right. Well, thank you, Jesse. I appreciate your time.
Thanks for having me.
All right. Take care, man. Have a good day. Bye.